Nebius is starting to look like one of the most interesting plays in the entire AI infrastructure space, and the latest news might have just confirmed the bull case. After already bouncing strongly in recent weeks, the company got two major catalysts that completely shifted the narrative. First, Nvidia announced a $2 billion investment into Nebius. That alone is a big deal. It gives Nebius early access to next-generation AI hardware and deeper integration with Nvidia's ecosystem, which is basically the backbone of modern AI infrastructure. But the real headline came shortly after. Meta expanded its existing partnership with Nebius from $3 billion to a massive $27 billion deal. That's not just a step up, that's a complete level change. And it tells us something very important. Meta is clearly satisfied with what Nebius is delivering. When a company of that size commits tens of billions of dollars, it's not experimenting anymore, it's scaling. Now, if you combine that with Nebius's earlier deal with Microsoft, worth up to $19.4 billion, you get a total backlog of roughly $46 billion. Let that sink in for a second. Nebius currently has a market cap of around $28 billion, which means the market is valuing the company at about 0.6 times its contracted backlog. That's extremely unusual for a high-growth tech company, but these deals do more than just look impressive on paper. They solve two of the biggest challenges any AI infrastructure company faces. First, they fund the expansion. Building data centers, securing GPUs, and scaling power capacity requires enormous capital. These contracts provide the financial backbone to make that possible. Second, they validate the technology. Nebius isn't just renting out hardware, it's offering a full AI cloud stack, from compute to software. And having companies like Meta and Microsoft commit at this scale is basically the ultimate proof that the product works. So fundamentally, the story has improved, not weakened. Looking ahead, management is targeting an annual revenue run rate of $7 to $9 billion by 2026. And importantly, that guidance was set before the massive expansion of the Meta deal, so there's a good chance actual growth ends up exceeding expectations. When you break down the valuation, things get even more interesting. Even with heavy upfront investments and conservative assumptions, Nebius only needs around 15% annual growth after 2027 to justify its current valuation. That's a relatively low hurdle considering the company is already scaling rapidly and has long-term contracts locked in. If you assume more realistic growth, around 30% per year, which aligns with analyst expectations, some models suggest the stock could be undervalued by over 200%. Of course, this isn't risk-free. Execution is still critical. Scaling AI infrastructure at this level is extremely complex, especially when it comes to securing power and deploying hardware fast enough. There's also capital intensity. These projects require billions in upfront investment, which could lead to dilution or increased debt. And right now, Nebius is heavily reliant on a small number of customers, mainly Meta and Microsoft. But even with those risks, the current setup is hard to ignore. You have a company with tens of billions in secured contracts, partnerships with the biggest players in AI, and a valuation that still doesn't fully reflect that growth. That's why this doesn't look like hype. It looks like a company that just received one of the strongest possible validations in tech and is still trading as if the market isn't fully convinced yet.